You can go. This is the last time. Go. Nothing, Brian. You go back to class. No online student now. Go online student or not? Okay, today I'm going to use PowerPoint to teach. Yes. I lazy. Okay. Your last page still got space or not?
Yeah, no, I think so. No.
How many people don't have space? You got the space or not? Oh my God, kids these days. What, no online student? Okay, come on, ready. Okay, the online student, E. Anything lah? Can you see the screen or not? Can you see the screen or not? Yes, say yes or no. Okay, good. Okay, today I teach using PowerPoint. Before we move on to the today's exercise, you need to know a few things from year 10. The thing that I teach you all. Okay, the chapter that I teach you all. First one is about irrecoverable debt. Okay, I think I will show the full page, then you can copy later. If not, you don't know where to copy, what is confusing, like just wait first. Okay, irrecoverable debt is what? What is irrecoverable debt? In a very professional way, you can say the debt that you cannot recover from your trade receivable. In a simple my way, say the guy die or run away. Okay, the guy run away or die already. So whenever the guy die or run away, you debit what account? Debit irrecoverable debt. And then credit trade receivable. Debit irrecoverable debt, credit trade receivable. Next one, you need to know debts recovered. What is debts recovered? His son or daughter come back and pay. Not daughter like you, better daughter. Okay, the guy who ran away now come back to settle the debt. Okay, or come back and pay lah. So whenever the guy come back and pay, debit what, credit what? Debit bank, cash, or XX. What is the XX? Sometime I have no money to pay, but I can give you my phone. You understand? They give you the property or something they give you lah. So whatever they gave you, if they give you check, bank, if they give you cash, if they give you other than that, whatever they think lah, they give. Okay, and credit what? Do you credit a trade receivable? No, because his account we already cancelled already. So we credit our income, which is debts recovered. Understand? Can you copy this? So relaxed. Benefit of using PowerPoint. Done? Next one. The next thing that we learn in this chapter is provision for doubtful debt. Next part that we learn in this chapter is provision for doubtful debt. What is the provision for doubtful debt? Estimated of irrecoverable debt. Estimated of irrecoverable debt. We call that provision for doubtful debt. Okay, but normally provision for doubtful debt, there are three types of provision for doubtful debt. The first one is you create or your provision for doubtful debt increase. Whenever you create a PDD or your PDD increase, it's your income or expenses. Expenses. Provision for doubtful debt is not a good thing. We estimate the guy will cheat us, so it's not a good thing. So it's loss, expenses. So whenever there's expenses, we debit what account, credit what account. Provision for doubtful debt is a year-end adjustment. So we don't open an expenses account. We straight away write inside the income statement. Debit income statement because it's your expenses, and credit provision for doubtful debt. Understand? And sometimes your provision for doubtful debt will be decreased. If your provision for doubtful debt decrease, then it's your income or expenses. Income. Whenever it's income, your income statement will be debit or credit. Expenses, income statement debit. If it is income, the income statement will be credit, and debit will be provision for doubtful debt. Okay. Okay, the first one, irrecoverable debt and debts recovered, and also provision for doubtful debt. I, the one, teach you in a year 10, the last chapter that we learned. And the next one, Miss Azurin already teach you all balancing, how to balance the ledger at the year end. That's our next topic. That one also you need to know before we continue. Done? Can I move on? Okay, next one is year end. Year end balancing, or you can that end of the year end of the financial year. Okay, end of the financial year, all the income and expenses, what happened to what will happen? What will do with the income expenses? In your ledger account, all the income and expenses, what do you do? End of the year. Huh? Will transfer to income statement. All the income and expenses will transfer to income statement. Example, watch me. Okay, purchases. This is the purchases account. Purchases account, is it your expenses? Purchases is your expenses. So in your purchases account, you have a balances there. On the January 1, you buy 100 and pay by check. Okay, okay. Assuming on this year, there's only one transaction. If you got other transaction in the debit side, you record all the transaction in the purchases account. And then end of the year, on the 31st December, on the December 31st, what we'll do, we'll take that 100, will become balance CD, BD or income statement. As I told you, all the income and expenses will be transferred to income statement. So we write income statement. Understand or not? Okay. So another thing, wait, let me complete the full. Another one is end of the financial year also. All the asset, liability and capital. End of the year, all the asset, liability and capital will be transferred to income statement or transferred to next year as a CDBD. Transferred to next year as a CD and BD. Remember, these are very important because this chapter we're going to balance up year end. So all the income and expenses will be transferred to income statement. Asset, liability and capital will be transferred to next year as a CD and BD. Example, this what account is this? Motor vehicle. This is the motor vehicle account. Motor vehicle account in a January 1, I buy a motor vehicle of 100. Okay. And December 31st, end of the year, the 100, what I do? Income statement or balance CD? Balance CD. Can I stop at balance CD? No, you are not allowed to stop at balance CD. If you have a balance CD, you balance up double line, and transfer to next year, 2020, January 1, balance BD. You understand this? Can you copy this? Okay, I got a question. Which one better? iPad, PowerPoint? PowerPoint better. Others, boys? You say only.
If you do the table, then I think it's the one, the iPad one better. If you are explaining this thing, then
Explanation is better, but do exercise, that one better. Just do a T like this one. Oh, but actually, if you understand the transfer thing, you don't need to copy the table actually. The table just to make you understand. If you understand what is the balance CD, BD, income statement, then no need. And it's take almost 1 hour to prepare the 3 slides. Okay, we done, then go to example number 3. Done? Another 1 minute before I continue. Huh? Okay, that's it for now. Go to example 3. Non-regular transaction. What is non-regular transaction? The transaction that not normally will happen. Example, purchases, sales, paying salary, paying rental, all these are regular or non-regular. Monthly or in 1 month, few times will happen. So that one is regular. Irrecoverable debt, provision for doubtful debt, all these are regular or non-regular. It's not regular, like 1 year once or 2 years once or 5 years once only, the irrecoverable debt all will happen. So whenever there's a like non-regular transaction, we cannot record in any other book or prime entry other than journal. We can record in a journal only. Okay, before you transfer to the income statement or whatever, you will record inside the journal first. So now we see the example number 3. Chan financial year ends on 31st October. He provide the following information for the year ended 31st October 2019. Irrecoverable debt, written off up to. Written off up to means they already recorded or they haven't recorded. Written off up to 30th October, they already recorded. If they already recorded, you no need to record again. You no need to record again. They already done already. Okay, it's 140. Already in the book is 140. Then continue. On 31st October 2019, it was decided to write off irrecoverable debt of 50 by Ansari. So this one done or not? Haven't. So we're going to do this. So they are writing off their irrecoverable debt. Debit what? Credit what? Just now only we got learned about this. Debit what? Credit what? Whenever the irrecoverable debt happen. So I go to the journal October 1. Sorry, when now? October 31. Debit irrecoverable debt 50. Credit, you cannot write trade receivable because you know the name of the trade receivable, you write the guy's name. If you don't know the name, then only you write the trade receivable. Do you know who's the guy run away? Ansari. 50. Am I done? No. You must have a narrative. What's your narrative here? You don't know what's going on. Writing off. Can. You can write writing off. Exam no short form. Exam no short form. Okay, and also the question asked me to do the journal and also ledger. Journal and also ledger. So now I'm going to do the ledger also. What is IRD? Then go to the ledger. Okay, before we continue, let me ask you a question. Can someone run away from me when the guy didn't owe me? Can the guy run away from me when the guy didn't owe me? No, makes sense, right? The guy must owe me first, then only the guy will die, then the guy will run away, then I record as an irrecoverable debt. So now this Ansari, now we are recording what? The guy die or run away already. But before that, the guy's account should have some balances or not? Yes. So can you check how much the balance in the Ansari account? Do you know? Don't know? The question didn't say, but what the question say is the guy ran away of 50. So it means the guy owed me 50. So Ansari is your trade receivable. Trade receivable balance will be debit side or credit side? Debit or credit? Asset. Ansari is trade receivable. Trade receivable is asset. Asset balance will be debit. Balance BD October 1. Okay, after that, before I continue, let me double check. E-recoverable debt. Do you have any balances in the e-recoverable debt? First day, first day of the month. This month is 31st October, right? From last month, I'll bring to this month. Okay. Do you have any balances in the e-recoverable debt? Do you have any e-recoverable debt that already written off? Yes. How much? 140. Until what date is this? October 30th. And what do you write here? No, you know what is the meaning of total to date? The total of this account until today. The total of this account until today. You can write total to date. If you don't like this word, you can write trade receivable written off. Also can. Up to you, but I think total today is better. Okay, now these are the balances that before the guy ran away, these are the balances in these two accounts. So now the guy run away ready. When the guy run away, I debit Ansari account or credit Ansari account? Credit 50. When? October 31st. I write here e-recoverable debt. And then go e-recoverable debt. I will write Ansari. Understand? Okay, before we move on, we need to balance up. How do you balance up? This one, the account close already. E-recoverable is my expenses. Expenses end of the year, what I do? Move to income statement. How much? Under 90? Under 90? Under 90? October 31st? Income statement. You understand? The blue color is the journal that we did just now, correct? The blue color is the one, the journal, debit, e-recoverable debt, credit, Ansari. That's what I'm doing here. Okay. So next transaction is create provision for doubtful debt of 250. Whenever you create the provision for doubtful debt, debit what? Credit what? Whenever you create a provision for doubtful debt, debit what? Credit what? Debit? Credit? How much? 250, 250. Give me 1 minute. Wait down. Okay, this is the answer. You copy the answer. I go take my charger. Hi, sit down. Done? Okay, can we record that in our ledger? This is my ledger, provision for doubtful debt. It will be in a debit side or credit side, the provision for doubtful debt. Why credit? Provision for doubtful debt is asset minus debit or credit. Adam wants to eat large chicken rice, asset. Asset increase means debit. Asset decrease means credit. You understand? Okay, good. If you don't understand, please tell me how I can draw and show you. How much? 250. When was it? October 31st. If your provision for doubtful debt increase means it's your loss. The loss will be transferred to income statement. Okay, we are done for this year. We will balance up this. How do you balance up? I said provision for doubtful debt is asset minus. Asset minus will be transferred to income statement or transferred to next year with the BDCD. Next year with the balance CD on the October 31st. You are not allowed to stop at balance CD. If you have a balance CD, must transfer to. If not, you will lose 1 mark. If you don't want the 1 mark, you can do that. No problem. You know? Next one. On 31st October 2010, Chan agreed to accept a human value of 100 from Khalid in a settlement of the debt written off during the year 31st October 2019. This is one transaction. Let me settle with this transaction before I continue. Actually, what is this? Irrecoverable debt or debts recovered or provision for doubtful debt? Debts recovered. Debts recovered, debit what, credit what? For this question I'm talking about, the acumen. The guy didn't pay cash, the guy didn't pay check. The guy give you acumen to settle the debt. So we debit the acumen, credit the debts recovered. Smart. Can you do it yourself? Hey, sleepy boy, wake up. Don't lay down. Lay down. Is it lay? Lay in a table. Later, my big bosses go here, go there, then they call me for their room, lecture me for 1 hour. You must explain. Explanation is a must. Okay, I need to do ledger before I continue. Can you go to the ledger? What are the two accounts involved here? Acumen and debts recovered. So debts recovered is debit or credit? Credit because it's your income. Right here, October 31st, you receive acumen. Then go to acumen, 100. October 31st. Debts recovered. Okay, end of the year, we balance up. Debts recovered is my income. Debts recovered my income. So the income, what I do? Lou. Income, what I do? Send to income statement. And equipment is asset. Asset, what I do? CDBD. But I'm not going to do CDBD here because normally equipment, right? We have other equipments also. So the question is not complete. Just leave it like that. Unless the question say balance up the equipment account, then only you balance up. If not, just leave it. Okay, after that, go back to the question page. Next one, they decided to increase the provision for doubtful debt to 310. Okay, actually, oh, I'm so sorry. This was supposed to be 2020. Not 2010, 2020. And here also 2020 now. 2020. Okay, this one is actually continuous from previous question. The previous question, how much the last year's PDD? Can you check the previous page? 250. Everybody can see that 250 last year. Okay, and this year PDD is 310. So your PDD increase or decrease? Increase by 60. Your PDD increased by 60. So what do you do? PDD increase means debit what? Credit what? Debit. Debit income statement. How much? Huh? Very good. Then don't forget to explain. Yeah. Exam no short form. Adjustment to PDD. Exam no short form. We need to do the ledger account also. But the ledger account must be continuing from last year. Can you check the previous page and how much is your, where your PDD account stopped? Last year, your PDD account stopped at where? It's in the credit side, 250. They write here balance BD, correct or not? What is the date? November 1st. On 2020. Understand? And this year, how much your PDD increase? 60 increase means debit or credit? Wait. November 1, what year? This year, 2020, October 31st, increase 60. This 60 increase means it's your loss. The loss will be transferred to, the loss I already transferred to income statement. Now my total provision for doubtful debt is 310. This 310 will be, this 310 will be 2020, October 31st, balance CD. Balance CD will become Done? Next one. Example number 4. Chan's financial year 31st October, he provide the following information. At 31st October 2019, Chan's ledger included the following, blah, 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 blah. The question asked me to record the journal for year-end transfer. Okay, if they say year-end transfer, I got 2 year-end transfer. Actually, the 3. The third one, I don't want to talk about that today. The 2 main transfer is income and expenses will be transferred to income statement. Asset, liability, and capital will be transferred to next year with the CD and BD. That's our transfer. So watch me. Be careful on that. Okay, the first example that I can see is purchases. Purchases is 39,000. If the purchases is 39,000, you debit what, credit what. If you want to transfer, you listen careful. If you listen, then you know already. Transfer from purchases account to income statement. So if you transfer the purchases is expenses. Expenses in an income statement will be debit or credit. Expenses in an income statement will be debit. So you debit the income statement, credit what? Credit the purchases. Why you credit the purchases? Because you take out the purchases. Your purchases will reduce in a purchases account, and these purchases will go to the income statement. Understand or not? So the answer is debit the income statement, 39,000, credit purchases. Who don't understand why purchases is credit? Because your purchases minus. You take out the purchases, your purchases reduce. Okay, and don't forget to write the explanation. Transfer of purchases for the year to the income statement. Okay, the maximum line that you can use for explanation is 2 lines for my worksheet. But in exam 10 also can, up to you. But my worksheet, I just leave 2 lines, so you need to squeeze in. Okay, can I stop here for this? No, you need to transfer to ledger also. This transaction must be recorded in the ledger. So I go to the ledger. Can you go find ledger? Okay, I want to transfer the purchases account, but can I transfer the purchases account whenever the purchases account don't have balances? No, you must write the balance first, then only transfer to income statement. So how much is the purchases balance? 39,000. What is the date? October 31st. And this is what? This is the purchases total to date. Until today, the total purchases is this much. So what do you do with these purchases? You transfer to income statement because it's your expenses. Okay, for sales return, I want to do ledger first, then we go journal. Can you check how much is your sales return? 2,460. Wait, sales return, the balances will be in a debit side or credit side? Sales is revenue. Sales is revenue. But this is a sales return. Revenue minus. Revenue minus will be in a debit side also. And what is this? Total to date. Until today, this is the total sales return. Sales return is revenue minus. Revenue minus is considered revenue also lah. So you transfer to income statement. Done? Can we do the journal for this? You can leave one line now. Debit income statement, credit, sales return. Okay, I don't want to waste my time to explain the explanation. Go by home, read yourself. Can you? Do you know what to write? Transfer of sales return for the year to the income statement. So you just leave 2 line or 3 line lah. For that, then later you can do go by home and write. Okay, next one. Next one is insurance. Listen. I know you're so excited to write. Go back home and write. Next one. Insurance 1,500, which is included a prepayment of 300. Okay, you want to do ledger first or you want to do journal first? It's up to you. If you understand, actually you can do journal. If you don't understand, then do ledger first. So what I understand here is this 1,500 is the insurance that I paid. And this payment is included the prepayment. You know what's prepayment, right? Prepaid of 300. You pay 1,500, then that 1,500 include 300 for next year or the prepaid. So how much is the expenses for this year? How much insurance for this year? 1,200. That 1,200 you will transfer to income statement, right? You transfer 300, 1,500 or 1,200. Which one will be transferred to income statement? How much is expenses for that year? That one will go to the income statement. So which one is the expenses for this year? 1,500 or 300 or 1,200? 1,200. Everybody agree that? You understand? Now you pay 1,500, but out of the 1,500, 300 is not for this year, it's for next year. So 1,200 for this year. Since you already know the 1,200, I'm straight away go to the journal. I answer. Leave extra 1 line and then right here income statement, debit income statement, because insurance is your expenses. How much that you will transfer to income statement from your insurance account? 1,200. Then you will credit from which account? Insurance 1,200. And you know what to write, right? Leave 2 line. Okay, then there's a problem here in the insurance account. So can you go to the insurance account? Okay, first you pay the insurance account, right? If you pay the insurance account will be debit or credit? Debit. Credit the bank account, debit the insurance account. Insurance increase. October 31st. Can I write bank? No, you cannot write bank because I don't know this 1,500 is 1 payment or 2 payment or 3 payment. You can pay 500, 500, 500, or you pay 1,500. I don't know. So the better way to write here is total paid. What is the meaning of total paid? The total payment that I made throughout the year. It can be 1 payment, it can be 2 payments, it can be 3 payment. I don't care. But out of the 1,500, total paid, out of the 1,500, how much I transfer to income statement? How much for this year? 1,200 I minus from here, I transfer to income statement because that's my expenses for the year. Copy this. Okay, after this, what happened? After this, I balance up 1,500, 1,500. So the balance 300 is my insurance prepaid. That's my insurance prepaid. Insurance prepaid is your income or expenses or asset or liability. Insurance prepaid means you pay extra. If you pay extra, that guy owe you or you owe the guy. That guy owe me means asset, liability, income or expenses. Assets. If assets, do you transfer to income statement again or you send to next year? Send to next year. So what do you write here? Balance CD. This balance CD will become understand now? All this you learn already in accrued the chapter 12. No, chapter 11, I think. Okay, chapter 11, chapter 12, all this you learn already. Done? Go back to the question. Inventory at 1st November 2018, 3,100. Okay, if you can answer this question, you're doing good in accounting. But none of you will answer correct. But let me ask you a question. Inventory at 1st November 2018 is the opening inventory. Opening inventory is your asset or liability or income or expenses. Answer. Asset. Other answer? Genius, you want to change the answer? Genius? Okay, you see, clap for you. Income totally wrong. Okay, when I was a student, my tuition teacher got teach me something like a stupid thing, but something that I use until now. What is asset? Asset is something that can give you a future enjoyment. You can enjoy with the thing in the future is asset. Example, I buy a laptop. Can I enjoy the laptop in the future? Enjoy means the laptop give you some benefit, not that type of enjoyment. Okay, the enjoyment, the normal enjoyment that you can use the benefit, get some benefit from the laptop. Is it yes? And one day Rosa, everything will Rosa, but can I enjoy in the future? Yes. Okay. I buy an Apple pen. Can this Apple pen give me a future enjoyment? Asset. I buy a pen, normal pen. Can the pen give me a future enjoyment? When I use the pen, decreasing. At one point, you cannot use already. But this one, is it decreasing because I use? No. So future, this one give me future enjoyment. This one didn't give me a future enjoyment. I'm suffering with it. I pay now, use now, finish. Okay, you buy a food. Is it asset? Food is not asset. Why? Yes, you can enjoy, but you enjoy, finish it now. Something enjoy and finishing now is your expenses. You lost it. Okay, future enjoyment is a asset. Future suffer. You suffer in the future. Asset or liability? Liability. I take a loan now. In the future, I need to pay back. I'm going to suffer. So future suffer is liability. I repeat again, future enjoyment is asset. Future suffer is liability. Current enjoyment, you enjoy now. Now I come, I work, I get salary. Current enjoyment is my income. Okay, current suffer, I pay for food, I makan, finish already. So current suffer is expenses. You understand this? Until today, I'm using this particular concept to decide which one, but you cannot use these terms in the exam. If you ask what is asset, current future enjoyment, you cannot use that. The examiner don't know this. This expenses. Current suffer is expenses. Current enjoyment is income. Future enjoyment is asset. Future suffer is liability. So opening inventory. If you say asset, the opening inventory, are you going to enjoy in the future with the inventory? What is opening inventory? The inventory that they didn't sell last year, they bring it to this year. Are you going to sell that one this year? You sell old one first, then only you will buy new one and then you sell the new one. So the old one will be sell first. So it means, are you going to sell the opening inventory this year? Yes, I'm going to sell this year. Last year they didn't sell, they sent to this year. I will finish this one first, then only I will sell the new one. And that's a concept. Okay. We call that first in, first out. The inventory that firstly come to the inventory, firstly come to our office will sell first before we open the new rack. Normally it's like that one. Okay, so come back here. So this opening inventory, it's your current suffer or future suffer, current enjoyment or future enjoyment. Future mean next year. Current suffer is what? Expenses. You didn't say to me, you're not confident. Oh. Okay, opening inventory is expenses. That's why, you see, I don't know whether you people can connect this one or not. That's why in the income statement, purchases is expenses. Opening inventory is expenses. What we do? We plus together opening inventory plus with purchases, and the closing inventory is asset. So that's why we take out from the expenses, you send to the asset. Can you see the concept or not? Opening inventory plus purchases. Okay, so opening inventory is your expenses. Okay, why I'm telling this long story? To decide this opening inventory will be sent to income statement or balance CDBD. I resign now. Income statement. Ayo. So leave one line, debit. Income statement. How much? 3,100. Credit. Inventory 3,100. And then as usual, transfer in opening inventory to income statement. Done? Okay, then let me do the ledger. Okay, you must have a balance first. Yes, I'm more smart. Ask me. Ask. You must have a balance BD first. This balance BD 2018 November 1. You know why? Yeah? Opening balance what? Opening balance will be beginning of the year. 2018 November 1. From last year come to this year, we keep it this year. Keep it here until the last day of the financial year. What is your last day of the financial year? 2019 October 31st. This one will be transferred to where? Income statement. Understand? Okay, go back to the next part. Next one is general expenses. Okay, glance through the full question. I can see here general expenses and here so general expenses accrued. So general expenses that you paid is this much. General expenses that you paid is this much. And general expenses that accrued is this much. So accrued end of the year, you plus or minus? Plus. Okay, so how much is the total general expenses for this year? How much is the total general expenses for this year? Then I go here, next page, right here, debit. General expenses, expenses means income statement will be debit. Debit income statement, credit, general expenses. You said just now 1,4. Since this is the new page, write the date lah. Explanation, same thing lah. General expenses for the year, transfer to income statement. Okay, next one. You go to the general expenses. Okay, this one, watch me, it's important. How much that you pay first? You pay 1350. If you paid one in an expenses account, will be debit or credit? Debit. 1350. This one you can write total paid lah. Or you can write total to date. Total to date or total paid, both are acceptable. October 31st. After that, out of the 1350, how much you transfer to income statement? Did you transfer the 1350 to income statement? You transfer 1425. You transfer more than how supposed to be transfer. So the difference is how much? 75. What is the difference? The general expenses accrued. If general expenses accrued, you plus, right? If you plus mean record in a debit side, it's correct. But what do you write? Accrued general expenses is the income or expenses, asset or liability? Liability. Liability will be CD, BD or income statement again. Balance CD. Can I stop here? Balance CD transfer to balance BD. Okay, if you're done, we will stop here. Let me take your attendance, then you can leave. Wait, online student. I can remember your name. Okay, online student, you can leave lah if you want. Wow, you too, huh? Today that boy, another CU not here. You are very good, eh? Focus on studies and answer my question and do everything. If the CU got okay, Emily taking. Yeah, no. Lee Zhang Cheng, no. Chloe, yes. Which CU is this? Tong, no. Okay. Liu, no. Aiden, yes. Lim, Nashita, got. Alicia, no. Tristan, yes. Thank you so much.